for multifamily, a really high cap rate, which then translates to strong cash flow because we can borrow fixed rate in the low sixes, 5 years interest only, 65% LTV. So then that you have strong cash flow. And then I think one, I was talking about long-term hold. So, I mean, that's something we'd want. Well, it's a newer, nicer building. Our business plan's a 10-year hold on that. And, that's how I've seen like the other people in Chicago and these big cities really make a lot of money. It wasn't just fix and flips. It was,
Hey, everybody. Welcome back to another episode of the Richer Geek Podcast. Today, we have Drew Brenneman. Drew's a natural-born entrepreneur. He started his first business actually at the age of 14 years old. Then he launched an internet business while he was in high school. I think the guy could not do a 9-to-5 job if he had to. What do you think? The guy's an entrepreneur out and out. In 2005, he founded Brenneman Capital, formerly Rise Invest, and co-founded the Blackhawk Investment Group in 2008, along with Dwell. He's a Chicago-focused based real estate investment property management group, and we're going to talk about what sets him aside in the multifamily world and what he's doing now. How you doing, Drew?
Great. Yeah, thanks for having me. Happy to be here.
Yeah, absolutely. So, all right, you just couldn't do the newspaper route, boy, and the ice cream. You started your own stuff at the age of 14. What was that mindset? Why did you decide, hey, I'm going to start something at the age of 14?
Yeah, I just wanted to do it. I wanted to make money. I just always was wired like that. When I was a kid, I remember I did a little concert for my parents, just in the basement playing a guitar or something with my sister, and wanted to charge him admission to the show, make some money from it. So I'll try to do the same thing with my son now. I get him, see if he wants, I can get him to invest his money. He's interested in it. He told my dad the other day, I'm investing my money like my daddy in apartments. So he was proud of that. So,
yeah. And it's so good to have like a couple generations instead of, it's like my parents. Oh no, you need to get a degree, go work for someone for 35 years, get a pension. And I'm like, oh my God, that's the most boring thing. So your son is, he's got it made. He knows he has that influence of being an entrepreneur.
I've been trying to do that slowly. And then he was listening to sleep stories to fall asleep. Anyone's ever heard of that? Like with the Calm app, or where they read like a story about a bear slowly. And he, ready for the worst endorsement ever, but I have a podcast as well, and he listens to that now to fall asleep. Not because it's so bad or boring. Check it out, Brenneman Blueprint. It's about real estate investing, but it's more, I think, soothing for him hearing your dad talk, or be interviewed. At some point he'll hear this as a story to go to bed, I'm sure. And, but he's learned actually quite a bit about real estate listening to this. It was very funny where he said something. He asked me a question the other day about, why I bought a property, a certain one, and he knew about it. One in Phoenix. It was interesting. He asked, I was like, had a question about it. And he, we lived in one of the rentals we had in Chicago for a couple years. And so he's getting exposed to the business. He's seeing people doing the deals. So then just kind of started out young and wanted to figure out what to invest my money in. And both my parents were teachers. So it was kind of like what you were hearing, but they weren't saying you got to go work somewhere for 35 years, but they were definitely saying you got to finish school and you got to, that stuff sounds risky for us. So we won't be, putting our money in these real estate deals or businesses or anything. But if you want to do it, that's fine. I mean, stay in school, get good grades, but they weren't at least giving me, I would say that's like almost bad advice, what you're hearing, from your parents about, where you got to do this or that, where they never were really pushing on what you got to do, thankfully.
Yeah.
So then I developed, I think, a pretty good mindset, a realistic, they weren't piping me up like I could do anything and wouldn't come out unrealistic or never failed at anything like that. So I think I, it worked out, and then wanted to see what I could do to invest my money. And I bought my first property, back in 2005, when I was going to college at UW-Madison, and did 4 deals there, bought 2 million of property, and then moved up to Minnesota to go work. I did work at 2 jobs full time as a real estate and investment analyst, and doing deals, underwriting deals. And well, it's at the first place I met what would be my first investor. It was the father of one of my interns there, and we met, and I kind of explained what I had been doing, and we decided to partner up in 2009 to 2019. We had bought about $100 million of property together. Didn't start out with a big with millions of dollars right away, but we did. For me, it was a big deal, a $2.5 million one to start, and just kind of worked our way up. Did good deals. So far on deals we've sold, my average return is a 24% IRR, and not unlike little 1-2 year hold periods. This was the average hold period on those same properties is 5.8 years. Mm-hmm. And then so your multiples, like solidly into the mid to high twos. And then a lot of the stuff that we've owned a lot longer. Like we've bought deals in 2009, 10, 11, 13. Most all those we still own. So, I think that's one thing that we've been a little different than most folks, and was easy to do starting out in a way, having one investor, seeing that we were both aligned on longer term deals, and then eventually as I started expanding the investor base, and we doubled our, let's say, assets that we properties in terms of just total dollar value. We had about 100 million in 2019. Now we're at about 220 million today. Expanded the investor base, and then really because I'd have people that wanted to invest in our deals over that time period, but we really actually weren't set up at all to take on outside investors. We were just sort of all set up, just one guy, we know what he wants to invest. We were focused on these deals where we would buy them, we'd raise the rents, then we'd do a cash out refinance, pull out all the equity, and just buy another one. So we didn't feel like at the time we needed a lot of investors with that business plan, but also we were doing smaller deals, and eventually we're like, why don't we just do some bigger ones? And then we realized we need to develop an edge. And so we realized what we should specialize in, where we specialized in just really only the top MSAs in the country for multifamily. And I can get into how we determine that. And then also focusing on the best locations within those top MSAs. So then we're getting better performance than just your average return in there, because we're focusing on the areas that are either the most high income, well-established neighborhoods, parts of the MSA, or the ones that are growing the fastest. So then because that's sort of the other area where we've done really well, is buying like on the, where it's already turned and just getting a lot better quicker. Mm-hmm. So.
And what class are you focusing on now?
Well, really probably I'd say the class B to like class A, but not brand new. Not the brand new class A. It still feels like class A to me, but like a lot of the deals in Chicago we bought, it would be like a 3-year-old building we're buying from the developer, but it's not like a tower where they're charging $5,000 a month for a 2-bed. It's like they're charging $2,800, which for on that property might be low, and it should be $3,400. So then that for Chicago, where you might have a couple earning $100,000 each in there, that's actually a reasonable rent. Obviously, that's a lot of money. But yeah, and then in terms of, I think I might have skipped the geographies, but yeah, started out in Wisconsin, then moved up to Minnesota. That's where we started doing all those early deals. And then I had moved to Chicago for my second job, because I did all this at the same time too. I was buying my own deals, running those, working full time, and doing the deals where I was partnering up. And so I did all that simultaneously for 3 years, just until it got to the point where the job was, I felt like it probably might cost me money if I kept it, like I'll be costing me deals. So and then I was in Chicago, so then I stayed there, and then the next 10 years for the most part all the deals were in Chicago. And then in 2021 we that's when we really looked at the whole country as where are the best markets to go. And then from there we bought in Phoenix and only in certain parts of the Phoenix market. And then I moved to Austin, Texas, and we're getting going in Austin as well as DFW. And then from there, I think we're, plans to go up through Nashville and the Carolinas eventually, not anything near term, but.
Yeah. So what made you, one of the things that's a little bit different that I'm hearing is you're concentrating on those large MSA markets where, a lot of people that I talk to, I don't want to be inside that major metro because that's where the costs are high. What made you decide to stick into that urban area instead of maybe just outside Chicago or just outside of Austin in these smaller up and coming different type of, the cities that are maybe suburbs of those.
And I think you have a lot less demand in those places. I mean, that's not where your average renter wants to be. And so to me, a lot of people, they think about what's the liquidity like in this investment? What's the next buyer gonna, and if you're, a deal in Scottsdale will be a lot easier to sell than one in, let's say, Casa Grande or something, to make it for the Phoenix locals, but just where that's, there's a lot more liquidity, and then also you have a lot more demand from the renter. So I think you get the strongest growth in those really established areas, so let's say if you're in Phoenix, like the Scottsdales of the world, or where it's growing fast, Midtown Phoenix, where it's turning and getting nicer. Like those are, that's what we've tried to focus on. And I think people that do well on the fringe of the MSA, I actually think that's just a game for the developers. Like you can, if you can build out there profitably and then sell it, like that makes sense. You can buy the next farm or ranch at the end of the highway and build on it, but that hasn't been our business. We're more acquire, run it well, or do a renovation and hold on to it type of play.
Yeah, and that makes sense. And that's what's great, everybody. You have all these different, you have the buy and sells, you have the fix and flips, you have the people that develop and sell. So there's not just one avenue in the multifamily market. And everybody, again, it's Drew Brenneman, and it's Brenneman.com, BRENEMAN.com. So let's talk about how you evaluate what are you looking for. You go into Chicago, you go into Austin. What's your criteria?
So really we want to be in those. So with our market model, what we looked at was we figured out what was correlated with the price appreciation. So we pulled in demographic and job and just income, population information, apartment fundamentals, single family home fundamentals. And then we looked at what was correlated with prices going up since 1990. And then we looked at how to weight those things going forward, so our model would match what happened, or mirror it as best we could, and then run it out forward. So then we've settled on, what markets to buy in, and some of them are not a surprise. Some may be on which ones we've skipped, but I think really what has set us apart is that we're really looking within those MSAs where we only would want to buy in certain parts. And so you already talked about that's the established or the fast growing areas. So we would look that up first. We have an internal location score that we use, like to put it in our sort of vernacular, where we want it to be, when we look at all the stuff we were scoring the locations with, where it would be, it would be a positive score that's a half standard deviation or more above the average. And a lot of the deals you see, it will be in you would see these B and C type properties that were built in the 60s and 70s that need a renovation. They're often in bad locations too. And so it's a bad property in a bad location with rough tenants. And so those deals we just skip right away. So if that comes through, we just go, this isn't an area we would buy, and it's probably not a property condition we would buy anyways, because we're trying to buy 1980s and newer deals between 5 and 35 million. We've bought some older ones, 1970s deals. They're in the right spot. And then in Chicago, you can buy a deal that's built in the 1800s even, but it's had a full gut rehab, everything but the bricks basically is new. And so that people really more think of as like, when was it fully gutted, as like the build date. Those buildings are actually nice to own because the bricks are 3 deep, and it's like you don't even need insulation if you have that much bricks. But anyways, that is, so we look at location first. And then from there, we're for a value add deal. So buying it and doing a renovation and releasing it, we're underwriting to a 15% gross IRR. It's typically like our move forward signal. And then that's been impossible to do the last 15 months for us. We've looked at 400 deals, and none of them have met that criteria. We also look at what deals that people call core plus, which, and like the institutional investors, they throw around the terms. There's core real estate, core plus, value add, opportunistic. And then core plus is just like one step up, maybe up or down the risk spectrum, I guess, whichever way you're looking, where it's a safer deal than like a value add one. So it's going to be a newer, nicer property, better location, but it's not like a core deal. It's not in downtown necessarily, high rise, class A type deal, but it's still newer, nicer, and then some element where there's some, hair on it or value add, but not as much as like a big renovation. So a lot of those deals where we were buying and then increasing the rents and doing the cash out refinances, those were properties that were 3 or 4 years old. You're buying from the developer. They never really maximized the rents. You pick it up at a fair price based on what it makes now, and then you just raise the rents. As simple as that in terms of, and so you get to an attractive cap rate, attractive untrended yield on cost, doing that compared to just buying a fully stabilized deal, but you're not taking nearly the risk you are in a value add deal. So that's that. And then we've also done a lot of loan assumption deals back when that was, we're doing those now as well, but that back when that was a negative. Right now it's a positive, but when that was a problem because the rate was higher than market and you're picking it up at a discount, and the debt's temporary and price is permanent, and so we like those deals for that. So that's really and then on the core plus, like we're solving to a slightly lower return than that, maybe a 13% gross. And we have a deal in Chicago that we have under contract, and we opened up to our investor list, and the underwritten targeted returns ended up being higher than that, but it was really like just a function of there's a lot of loss to lease on the property, and we are it's in a market we know really well. I own 16 buildings in Chicago, and the best comp for this building we bought from the same seller in 2020. So we just realized the loss to lease opportunity, and we will be able to stabilize that at a 7 cap on a tax adjusted basis. So for multifamily, a really high cap rate, which then translates to strong cash flow because we can borrow fixed rate in the low 6s, 5 years interest only, 65% LTV. So then that you have strong cash flow. And then I think one, I was talking about long-term hold. So, I mean, that's something we'd want. It's a newer, nicer building. Our business plan's a 10-year hold on that. And, that's how I've seen like the other people in Chicago and these big cities really make a lot of money. It wasn't just fix and flips. It was, they bought like one guy I bought a property from, his dad, he bought like 50 duplexes in the Lincoln Park neighborhood, which, one of the nicest neighborhoods there back in the 1970s for, on average 50,000 a duplex. And conservatively now, if someone said, what's your average duplex worth there? I'd say 900 grand. I mean, lot value is basically 800,000 or more in those neighborhoods. So, so I don't know what his IRR is, and he probably doesn't either, but that's how a lot of people made a lot of money. And it's, it's hard to get your hands on these good deals. So I'm really more of a longer term holder, and I like, if I can, to have some liquidity along the way through a cash out refi, but not over lever it where then there's no cash flow or you're at risk of a problem. But that's how we did a lot of these Chicago deals. We bought them, raised the rents right away, then we did a cash out refinance in the second year at some point, returned on average all the capital. We did this on 13 deals where we did it 100%, slightly over 100% on average cash out refinance, and then we kept the property. From there, we just had our profits left in it. So, I mean, that's ideally the business plan with this. We're doing a 5-year fixed rate loan, so that refi would not come in year 2, it would come in year 5 at the end. But then from there, we would have, we would have grown the NOI a lot. And then, ideally interest rates are down somewhat, and that will help with the refi. But even if there isn't, there'd still be a good cash out opportunity.
And that's amazing that you're finding, because I only know the Phoenix area here, and we're at 3.5 cap rates. It seems like 4 caps on a lot of these.
That's moved. It's a 5.5 now. Yeah, all day. We're still in the market. Yeah, no. Your average run of the mill multifamily cap rate, it would be a I'd say a 5.5 in Phoenix, 5 in DFW, and then a high 4s in Austin, and then Chicago, plus or minus 6%. And then the reason we can get it to a 7 is because of the under market rents. Was the developer rented it at one number. Chicago has had really a lot of rent growth the last 2 years. It's actually the last 3 quarters, the number one market for rent growth in the whole country. And on our buildings that we have, it's last year we, depending on the building, increased our rents 5 to 9%, and then this year it was similar, 5 to 9%. So back to back huge years, and then this owner did not keep pace with that.
Yeah.
So that's the opportunity. And then that's to do those kind of deals, you just really need to know what's going on in the local market. And if we didn't already own a lot in Chicago in a very similar building, a lot of the people that are probably trying to maybe made a run at buying this building as well, they might not have realized the loss of lease that was there.
Mm-hmm.
So that's also why we're, one thing with specialized in multifamily in only some markets is the more specialized you are, the better you're going to be at it. And that's what we realized that would be our edge, where if you were just going to do apartments, sure, you specialize, but then if you're going to do it across the whole country, you're never going to know as much about Chicago as I lived there for the last 10 years. I recently moved to Austin. You're never going to, it's going to be really hard to catch up on what we know being there and investing there. And so, specialized in product type, but only a few markets. That's where we found the best, people getting the best results do, and then start developing a really good team and technology and sort of everything around that.
What do you see in the future? And that surprised me. It's I don't understand why with the interest rates, the high rents, why the cap rates would be reversing. Why do you see that trend? Why is it going up, especially in some of these hot markets? Why are they going up to 5.5, 6?
The growth slowed or stopped depending on the market, or rents dropped even. I mean, in the Sun Belt, let's say the areas where the cap rates were in these 3s and 4s, like you're mentioning, people to pay those kind of numbers, they're anticipating the following year they can mark the rents to market, meaning the current owner's renting, let's say, the 2-bedroom, 2 baths out for $1,200, but market now is $1,400 with how much the market's moved. So I just need to move these rents to $1,400, and now my 3 cap turns into a 4.5 cap, and then I'm in this market that's growing fast, and pretty soon it'll be $1,500 and on up. But what happened is on those deals that people bought while you're in the middle of raising the rents to $1,400, your interest rate, everyone was doing floating rate debt, because that's what, if you wanted to go in a higher leverage, 70, 75% loan to value, you had to go floating rate, because those were the only lenders that would lend at that high loan to value were the debt funds or banks, if you want to do full recourse. Yep. And they were sizing to your stabilized NOI in year 3. NOI, your net operating income. So what the property would make in year 3, not what it's making today. So then you explain, we get the rents to $1,400, we'll grow them 2 more years, and now we'll be here. And they give you a loan based on where it's going to be here in year 3. But now what happened is, interest rates went up. So you got a lot of people that are going to need to add money to their deals in order to pay those loans down, and then right size them based on the higher interest rates and also the growth not being there. So I guess I started talking about debt and didn't exactly answer your question, but the answer why cap rates went up is twofold. The growth stopped, and then interest rates went up. So people were only paying 3 caps because interest rates were in the 3s and the growth was tremendous. So now if you go, what could I pay if interest rates are in the 6s and there's not as much growth? I mean, honestly, a 5.5 cap is still pretty aggressive. You have negative leverage.
Yeah.
When is that going to turn positive? And that's why I like the Chicago deal we have now, is because we don't need anything to change. We're stabilizing to a 7 cap. We're doing fixed rate debt for 5 years. We don't have a business plan where we're saying we're going to sell it in a year or 2, because I don't know where the market's going to be in a year or 2. If it could be up, could be down, but we'll be locked in with fixed rate debt in a market that's very stable. It would be better if at times Chicago would be more up and down during the ups, but it's very stable. It's number 1 for least new supply in the top 20 largest markets. So there's not like a tidal wave of supply coming like some of these cities. That'll be another headwind. And still the nice neighborhoods in Chicago, they're still growing. I know the national headlines on Chicago and Illinois is it's losing people and all that, but it's not. The population is definitely shifting within Illinois, and the nicer neighborhoods in Chicago are gaining people. Like the West Loop is the neighborhood this deal's in, and that is they're still building new office buildings there. Even there's so much demand. So like the McDonald's moved their global headquarters from Oak Brook to the West Loop. Google's got a big office there. There's a ton of employers and new buildings popping up. So it's different than maybe what you would think of with Illinois. And so what I like about it though is that nothing needs to change. the rents just need to stay where they are in the market, and then we can raise our rents to market.
Mm-hmm.
We'll have a fixed rate loan. We don't need anything to change. What's kind of still scares me, even if some of these Sunbelt deals are 5.5 caps, you still need to do something to get them to positive leverage. You need to renovate them. You need to get your rents up even more. I mean, where it's so and then who knows in a year or two how many deals are going to be on the market when all these floating rate loans expire.
So your new opportunity in Chicago, let's get to that real quick. And everybody, again, it's Brenneman.com. And I'm sure there's a tab where you can check out the investment. Is it a syndication?
Yeah. 506C verified, accredited. Is how we do it.
Okay. Minimum investment?
Yeah, 50,000.
Yeah. And you're looking at, if I heard you right, like this is going to be more of a patient, longer term. And that's what you like to do now. It's a 10-year.
Correct. Yeah. And it's just, projected to start out 6% cash on cash and then just go up from there. And so I think, what I've liked about it and kind of the response has been like, that's like for this market, high cash flow for multifamily. And, then you have, and also your share of the upside on the price increase, the appreciation that we'll realize over the next 10 years. So I think and then we have the refinance opportunity at the end of year 5. So yeah, it's been really a good reception on the deal. And I think too, what a lot of people have liked is they just that it's something different. I mean, a lot of people the last few years, it's a lot of Sunbelt renovation, stuff. And we're doing those deals too. So, I mean, there's a time and a place for those, and we're renovating apartments in Phoenix right now. Like there's still a time and a place for those, but thankfully all but one of those Phoenix deals, we did 5-year fixed rate loans at 3.5% interest, or one was a 7-year at 4.25%. So those deals are fine. But we, I think the less moving pieces you can have in your deal right now, the better. So that's the main thing that people have been liking is this is just simple, kind of basic real estate. There's not a lot going on. You're buying a newer, nicer property, starting out with relatively high cash flow and just growing it from there. So then the price we're picking up at 15% below the lowest comp in that submarket, which was a deal we bought in 2020. So it's at that point we thought we were picking up something at the bottom in the middle of the pandemic, but with higher interest rates, there's even a better opportunity now, I guess.
I guess so. Well, Drew, I appreciate you coming on. Everybody, again, it's Drew Brenneman, Brenneman.com. If you're interested in diversifying your portfolio, getting into not a C or C minus, but a nicer Chicago area, West Loop apartment complex, check it out, Brenneman.com. Drew, thank you so much for coming on the Richer Geek Podcast.
Thanks for having me. Appreciate it.